Craig Berry here with the Mortgage Reports podcast. Today we're discussing why higher mortgage rates have actually been a good thing and all that has come because of these higher mortgage rates. And we're going to dip into a few of the other areas regarding financial literacy in today's market, as well as how lenders can have a bigger impact on today's world of real estate. Joining me today is Arjun Dhingra. Arjun is a 22-year mortgage veteran, two-time Taekwondo world champion, and former Team USA co-head coach. Arjun's mission is to help industry personalities become indispensable through personal growth, market moxie, and mindset, as well as helping bridge the financial literacy crisis that we have here in the U.S. He's the founder of My LFG Energy Society, launching later on this year. And Arjun, welcome to the show.
It's good to be on with you, Craig. Big fan of what you do, man, in the space. So this will be fun, but it's a privilege. Thank you.
Oh, absolutely, man. It's my pleasure. So, Arjun, what got you into the mortgage business?
I mean, it's all an accident, right? Nobody grows up wanting to be a mortgage guy. You fall into it. It's by some way of accident. Yeah, it's the truth. Nobody. I mean, I was in college and I was looking to go to graduate school because that's just what I thought I should do, you know, and then being the son of Indian immigrants, you just keep going to school. You rack up degrees, you know. And my dad had done his MBA and I wanted to kind of emulate his pathway because I knew I wanted to be in business of some kind. So I figured an MBA, graduate school was the next thing. But my senior year of college, I had some buddies that had dropped out of school and I was living in a fraternity house in Reno. They dropped out and moved to Vegas and started working as mortgage brokers. And these guys started making so much money that I thought they'd become bona fide drug dealers. Like I went down to visit one of them and he picked me up in a Mercedes. And meanwhile, we're like 21, 22-year-old broke college guys. And I'm like, what are you guys doing? And they said, we're in the mortgage business. And I said, what is a mortgage business? Like I couldn't put any of it together. What is a mortgage? Yeah, that tells you how much I was paying attention in college, right? I couldn't even define what a mortgage was, but I just knew. I was like, look, I mean, like anyone at that age, of course, like we're all attracted to success and money and opportunity that way. And I saw what these guys were doing. I'm like, how do I do what you guys are doing? So they needed some help. I started literally visiting people's houses, taking written applications because that's how it was back in 2001. Taking written applications at people's homes, you know, for veterans going, you know, to neighborhoods, and they paid me per household, which was awesome. And I was already making more money than any college student at that point. And then I said, okay, I want to do what you guys do and open up a branch. So my brother, another partner, and I opened up a branch, and you know, that was it, man. 22 years later, I still haven't gone to graduate school. So I put it on hold.
And you forgot to include the fact that interest rates were almost 8% in like 2001. Yeah,
you're exactly right. I remember literally going into people's homes, Craig, with the rate written on the application because I wasn't setting the rate. The guys I was working for was. So they would send me a stack of applications that I would take, the 1003s, where the rate was written in. And I remember walking in to people's homes with a 7.5% rate. And the clients were ecstatic. I can't believe I can refinance to a 7.5%. This is such a phenomenon because they were coming out from 9, 10, 11. I saw a lot of double-digit handles at that time that people had, veterans especially. So they were doing these, you know, VA streamlined refinances, dropping down to 7.5%. They were ecstatic. It was the greatest thing to them. So yeah, to your point, that's where rates were at that time, which is feels like another world.
It really does. And you know, I think the perfect tie-in is going to be what we're going to get into here today. And you know, it's all about perspective because, you know, we've gotten really used to these very low interest rates. But, you know, I got in 99 and I mean, same. I was taking people from double digit interest rates, refinancing them down to, 7.5 or what have you. And I was a superhero. You know, so we're going to get into that a little bit more. And, you know, why don't we just jump right into it? So, you know, you have said that higher mortgage rates, as we've seen lately, are actually a really good thing for our current housing market. How so?
Yeah, and I know you agree with this too, because you're, you know, a veteran of the mortgage industry. So you've seen it, and you know that opportunities come when there's shifts in markets. And this shift basically has normalized our market. And I know that could sound a little dumbfounding to some people, but it's normalized things because what we had over the last several years was completely unhealthy, savagely unhealthy, as some very, very prominent economists will refer to it when they look at housing. There was nothing normal about that market. So when people are like, man, I don't like this market we're in, just recognize we left a crazy market. And what we're entering into now, which I feel is still working through its iterations, it's kind of figuring its way. But this is more normalized, where things maybe sit for longer than 5 hours before they sell. That's not unusual, people. Like a home sat for 2 weeks. I don't know. It seems like that's a bad egg, or that might be. No, that's actually very normal. It was not normal for a house. It was not normal for a house to sell in 5 hours of coming on the market, or, you know, a long line of people around the block to wait for it, and then everyone just paying tens of thousands or hundreds of thousands of dollars over the asking price. Nothing normal about that. So what you had was, and this is where we had, you know, housing inflation actually kick in, and that definition is just too many people chasing too few products, or too many approved buyers with access to very cheap money chasing too few homes, because we have really an inventory shortage or an inventory crisis, if you want to think of it that way. So what higher rates did was it flushed out a lot of speculative buyers. So it reduced competition. We still do have a disproportionate amount of people with their hands in the air saying, I want to buy, to available homes. And that's why prices haven't come down despite rates having gone up. But what rates having gone up has done is created an opportunity because of less competition and the ability to do something that was never spoken of a couple of years ago, and that's called negotiate. Negotiations can actually take place now, where sellers have to sit at the table with you and we try and come to a deal. And again, that's a very normal market. I feel that people find shock with that because we got away from it, where sellers didn't even have to be there. They were so arrogant, they literally left the room and said, you bring me the highest and most ridiculous offer and throw in your newborn and maybe we'll accept it. And buyers were at that mercy and they had to do it. And that's where you saw all these people, and that's what's really caused that run up in prices. Ordinarily, through history, when prices go up, when interest rates grow up, prices come down or they level off. That hasn't actually been the case, and that's because of this inventory shortage and the fact that demand is still really reasonably high. But what buyers have been able to do, and I've seen this opportunity come about, and some of the best deals that we've underwritten as a bank and that I've seen have had really great incentives attached to it. And meaning that they've been able to negotiate maybe a little bit off the sales price, or they've been able to negotiate a credit to buy down their interest rate, or do a 2-1 buy down to where they could get a rate that they would have gotten, say, about a year and a half ago, right now, make the payment more affordable and get in. They were able to negotiate repairs. They were able to negotiate a new roof as part of the deal, whatever. There was other ways to get financial concessions brought in, irrespective of the rate and price. And here's the kicker for everyone. The interest rate you get, and this is going to sound a little perplexing, but the interest rate you get actually doesn't matter in the grand scheme of things, because nobody ever holds an interest rate long enough to realize whether it was a good one or bad one. Our parents' generation kept a mortgage for a very long period of time. That generation stayed in homes for a long period of time. So it was not unusual to look at this entire mortgage process and this decision in the context of a 30-year period and really look at that truth in lending statement and say, this is how much interest I'm going to pay. That statement is actually more moot, and it's probably the most moot document in the entire stack of loan documents, because the average person in the United States refinances every 3 to 5 years, because that's the cycle of rates going up and down and creating opportunity. They move every 5 to 7 years. So when you take that into account, this 30-year number of how much interest I'll pay and what this rate means and all that really doesn't matter. The rate is nothing more than a placeholder, but it is giving you access and an opportunity right now because you've got less buyers. Some people are spooked. They've exited. So if you're a serious buyer who's locked in and you want to move for the right, genuine reasons, not because real estate is a fad, but because you guys need to upgrade your lifestyle. You need to move into that area for your kids to go to school. You want a bigger home. You're tired of renting. Whatever your personal circumstances are, if that timing is right, the rate is going to be nothing more than a placeholder to get you in and an opportunity where you can get a better deal. And then you're going to be able to restructure your financing later, probably in a much shorter window than that 3 to 5 year period I gave you. And that's a whole nother conversation, Craig. But long-winded answer to your question there, that's what I really feel and have seen. And I know you've seen it and other mortgage professionals around the country have seen it. It has created a massive opportunity. So when everyone else is running scared, if you're serious about what it is that you want to do for you and your family and you stay locked in, there could be a huge, huge opportunity waiting for you if you just stay patient and focused.
No doubt. No doubt. Very well said. And, it's probably been overused so many times, but I remember when I first got into the industry, and of course, this is going to date me as well because of the fact that we're talking about writing checks, which half the people don't even have checkbooks anymore.
No.
But I used to tell people, that it's not, if people didn't know what the interest rate was today or what was a good rate, and what that then was translated to as far as a payment, when you write, this is what I used to talk about, when you write a check for your mortgage payment every month, you don't write out the interest rate. So people don't really understand the interest rate and what it means as far as payment. It's just that what they hear, and of course, a lot of that's media and whatnot, but what they hear is a good rate. And so that's what get lodged in their heads.
Mm-hmm. Right. I think
it's wild.
It is. Yeah. I think just people attach value to this price, and they end up commoditizing the entire experience when really it's about so many more things. The interest rate, I tell clients, actually matter. It's not even the top factor in whether or not this is going to make good financial sense for you as a home buyer. It really isn't. And that sounds perplexing. Like, shouldn't it always be about the interest rate? Reality is you can get any rate you want. It's just a matter of like whether you pay for it or not. And is that actually a good move to make? No, it's more about the overall picture and, making a good sound financial decision. You've got other advantages that you get, like tax breaks, or tax advantages. You're not paying your landlord's mortgage off anymore. You're paying your own. There's so many other advantages to home ownership that don't have anything to do with the actual physical rate. And that's where the opportunity and that's where the focus should be. Because again, the rates come and go. And even if you stay in that home for a good number of years, you're going to restructure that debt at least a couple of times.
Yeah, I agree. Now, and so on that note, I'm going to put you on the hot seat here real quick.
Yes, sir.
So with all that said, is now a good time to buy?
If it's the right time for you and your family in terms of those personal circumstances that I said, because life events are what drive these big decisions. So a lot of people in our industry are saying, this is the greatest time to buy. And then a consumer who's skeptical is like, of course you're going to say that. You're a real estate professional. You're a mortgage guy. You're a real estate guy. And weren't you the same people that were saying this before 2008? It can go down those whole rabbit holes there. Right. But at the end of the day, it's not for everyone. And I'm not someone that says every single person should own a home. Anyone who wants to own a home should have the access to owning a home. That doesn't mean every single person out there should, because if we had all owners, we'd have no renters, right? There wouldn't be any harmony in the marketplace. But for those that have the life circumstance, whether it's a good one or a sad one, sometimes divorce happens, right? People need to move. They need more shelter. Shelter is never going out of style, folks. That's the one thing to remember here. This isn't Bitcoin. It's not some speculative investment or asset class. This is a home. This is a roof over heads, and that hasn't gone, nor will it go out of style. From comfortable caves to now modern mansions, shelter is always going to be a thing. But if it's the right time for you and your family because you need to move or you're upgrading or you got a job, you relocated, you're downsizing, you need to move in with family for health reasons, whatever it is, that's going to be there. And that's irrespective of what's going on in the rates. If you got to move this summer because your kid needs to get into that public school, the basis of that decision isn't around interest rates. Interest rate probably comes down to about third or fourth, maybe on that. It's really about, we got to do this because our kid needs to get into school. So again, life events drive these decisions. And if the life events are lined up for you, then it is absolutely the right time for you to do it because it's that time in your life. If it's not that time in your life and you're only predicated on where rates and prices are, then perhaps it's not the right time. And it also may not be the right way of going about that decision, but that's another conversation. So answer your question there, Craig. And I know it sounds like a kind of an easy out. If it's right for you and your family or you as an individual, then it's the right time in the market, irrespective of what's going on with prices, because there's always opportunity in real estate, always.
I couldn't agree more. Yeah, I'm going to get a line of clothing made. It's just going to all say, it depends. because there's so, I get that question all the time. Like, is it a good time? Should I buy now? Should I refinance? Should I, and it depends. It always depends. Right. It depends on your situation. Your situation is different from everyone else's. So you can't really answer that question without knowing an individual's circumstances.
That's right. Agreed. Yeah. Well said, Craig.
Thank you. Thank you. So, hey, let's talk about financial literacy in America. Yeah. I know that's something that you feel pretty strongly about, and I would love to get into that a little bit. So talk about that.
Yeah, no, I feel, after those of us that lived through, and you're one of the few friends I've got that I talk to these days that can relate to this, right? Those of us that lived through the 08, 09, crash. The biggest thing that came about in the aftermath of that was just, and it's sadly, it's still there in the marketplace, was how misinformed people are about using debt instruments like a mortgage to their advantage, right? And then when I started peeling back more layers, because it happened to me, right? I made some really miscalculated moves with speculative real estate investments and rentals and flips and all that stuff, like a lot of people did during that time. But in the wake of that, not only was the mortgage part of it something that I was a little bit saddened by, in terms of like, man, I wish I knew this. I wish others knew this. I wish others had this take on it or had this much more information. There's also other things, as I've learned over the years in looking at people's financials, right? And the sad, kind of dirty little secret about the United States economy is that, and I'm very much a pro-US economy guy, right? So don't take this the wrong way, is that it's all predicated on spending and consumption. But most Americans don't spend within any sort of constraints. That's why the access to credit is so easy here. A college student can go out and get tens of thousands of dollars in credit card access in line and then go out and spend it on stuff. Makes the economy look good, makes people feel good in the moment from getting that high of retail therapy, whatever it is. But then now you're in debt and now you're paying heavy interest on it. And I've seen so much of this. I was victim to it myself in college, and I've seen it, and I've recognized in looking out there, nobody in terms of universities themselves, very few households, the access to information, nobody's doing anything to really combat this. Now, to so many people's credit on YouTube, YouTube's one of the greatest universities there is in the world, and it's free. There's all kinds of incredible financial literacy. And I wanted to take on the mission too, for that anyone I serve and come into contact with in the circles or spheres of influence that I have via social media, to really help bridge this gap. Because I've seen countless clients come to me with an offer in hand saying, I'm going to take this deal from such and such bank. And I'm looking at myself like, how could you? That is terrible. How are you not seeing this? I feel it's incumbent upon me, whether someone goes with me or not, to at least share what I feel is in their best financial interest. And then maybe the light bulb goes off and they say, oh man, like that could have been a really bad move. I didn't even think about that. I was so fixated on rate, I forgot and didn't even realize that I'm paying so much in costs. And this rate is going to do nothing more than just give me bragging rights at my housewarming party. But really, when somebody actually looked at how much I paid for it, I lost big time. So it's just an optics thing. I've seen that. I know you've seen it, Craig, over the years. People get caught up in these things. So I've made it a mission over the last several years, since I became a more active content creator and using social media to try and help and impact and influence as many people's good decisions with this stuff, to just really shore up that financial literacy gap we have here in the United States. Because it's there. Nobody teaches things really well in households. Money is an uncomfortable subject. Sometimes parents themselves don't feel confident about their own money skills. So what are they going to teach their kids? And then the cycle just repeats. So teaching people good budgeting and saving and management skills, and just how to look at money and view money a little bit differently, and kind of, scale back some of those compulsive types of decisions that people make when it comes to money. If I can help more young people and young adults figure that stuff out, or young couples, and then they end up in a much better spot later on in life, then I've done my small job, because I know there's so many tens of thousands of other influential people doing this. And I think now we can see it everywhere, right? Like there's shows dedicated to this. There's Netflix specials. Like financial literacy is a big, big deal. It's a big topic. A mortgage is a huge debt instrument. If it's used responsibly and if it's used strategically, it will set you up to expand on your family's net worth and wealth in a way that nothing else can. But it has to be done the right way. And that's the mission that I'm on. So I enjoy it. And it's kind of made the industry and the job a little bit more exciting again, as opposed to just, underwriting loans. But that's my shtick with it.
Nah, I love that, man. I love it because, it's you can speak to this. It's not easy after you've been in an industry for 2 decades that has as much turmoil as we've experienced in this industry to still have that kind of passion about it. And I think sometimes it's because you have to kind of rewrite the script. You have to figure out, what's important to you and why are you doing this? And when you can figure out kind of your mission and your why, and for you, you're talking about, helping some of the younger folks not make the same mistakes, which, that's the best way is to learn, not from your own mistakes, but from others' mistakes. That's awesome, man. I really like that a lot.
Sweet, man. Thank you.
So, absolutely. So let me ask you this. What are some of the ways that you think that lenders can bring more value to today's real estate world?
I think it's just that. It's the same pathway I've gone through, because it's too often that people in our industry, and I fell victim to this for a while, which is why I kind of shifted, because I nearly quit the industry 16 years into my career. So 6 years ago, I nearly quit it because I'd been commoditized. I was being thought of as nothing more than a rate vendor. And I'm like, I'm way more than this, but everybody thinks of me as this. A big part of that was my own fault, because you kind of get what you tolerate, or you get what you create in the way of perception and optics. The other part of it is that the industry just views mortgage people as just this. Kind of like you call 3 different insurance brokers to get a quote. That's a vendor. That's not a partner. You're not talking strategy with them. You're not talking about how can I actually strategically use this policy to make sure I have other things covered and set myself up. They're just giving you quotes. Mortgage people can very easily fall prey to that. Here's my quotes. Here's my rates. This is all I have. Then you become a one-trick pony. And now you're pigeonholed, and it's just a race to the bottom, because anyone can be shopped, and there's always going to be a lower rate out there. So if you're a lender listening to this and you feel like, man, like I get dismissed, I'm not really respected by my realtor partners, my referral partners, the wealth advisors I deal with, the clients, they just call me and say, what's your rate? Like, why aren't they asking me other questions? Why aren't they really sitting down with me? You have to change that. You have to change that dynamic. The way you do that, first and foremost, is to hone in your own craft. You got to get sharper. You got to get back in the gym, so to speak, and get yourself in shape, which means figure out all of the ways in which you maybe are falling a little bit short from a knowledge standpoint, and shore up those inadequacies. I got to get better at understanding economics. Okay, boom, we're going to commit to learning that. I got to get better at understanding markets and money and what influences mortgage rates. Good. Okay, I got to get better at that. I'm going to study. I got to get better at becoming a content creator and a video marketer so that I can help my real estate partners with something other than bringing rate sheets and charcuterie boards to open houses, because I want to be viewed differently. You want to be viewed differently, you got to act differently, and you can turn the tables on anyone in this game. I really mean that. And that actually is something I'm even more passionate about, is changing the dynamic of how the unsung hero of every transaction, which is the mortgage guy. No disrespect to real estate agents, but let's be honest. We are the unsung hero of every real estate transaction, right? You're on the outside, potentially, in the waiting room with the patient's family, telling them stuff. The people that are under the knife, under the hood, actually trying to figure this thing out, resuscitating a deal that may have died a few times during surgery. Whatever it is, you don't know. All you know is you wake up in the recovery room and it's all good and you get handed keys, but you have no idea how tough that was. That's the stuff that we're doing as mortgage people. And I think we need to kind of be viewed as such, but we need to tell those stories. We need to exert that relevance so that people no longer dismiss us as irrelevant. And you got to hone in on your craft. So what I started doing 6 years ago when I contemplated quitting was figuring out how I can become better known. Because if you're better known and social media, understanding and following great podcasts like this one and learning and leveraging tools and becoming an information and knowledge broker, these are all ways in which you're going to do it and increase that visibility. Because the more people know who you are, you'll get more opportunities, more respect. That'll lead to more conversions and more dollars. By then getting sharp at the things that you need to offer, because then you become an indispensable growth partner. Now it's where you attract business and you no longer beg for it. Now agents are like, I have to work with Craig because Craig adds so much value. He makes me look so good. Sure, I could refer them to an e-lender that's over here in Silicon Valley, and they're going to talk to some loan officer on a headset that's just reading off a script, and they get phenomenal rates. Great. Okay. But when they talk to Craig, they're actually going to get an incredible experience. They're going to make a sound financial decision. They're going to have an advisor for life that's really going to help them. Like, I can't afford to not work with Craig. You create that, you'll set up all kinds of winning relationships, guys. and an endless stream of referrals that isn't just dependent on real estate agents, but you become valuable to attorneys, you become valuable to wealth advisors and money guys. And now you're going to have to expand your team because you're not going to have any idea what to do with all this lead flow. So stop begging for business, find ways to attract it, get sharp at your craft, become really visible, and bring more to the table than just rates. And you'll find that this business can actually be really, really lucrative, and you won't be subjected to these seasonal flows because you're always in demand.
I love it. And, I'm gonna veer off. It's still related, but
yeah,
you said something about the whole commodity thing. And, I think that if you've been in the business long enough and you genuinely are motivated with the right, you have the right interest in mind. In other words, it's to help people and really just try to get to that next level in your business as a as somebody who's knowledgeable and who is going to give someone else good advice about buying or refinancing. When you feel like you've become a commodity, it is, and I have been there. I have almost gotten out of the business for the same thing because I just felt like, this isn't why I got into this. I'm not trying to be the cheapest guy, the lowest guy, or anything. And because, as you know, Arjun, you're going to be jumping from mortgage company to mortgage company if you're just always chasing rates and chasing costs and things like that.
One trick pony.
So, yeah, no doubt. So, with that said, a lot of agents will only give out like 3 names or whatever it is that they do because they feel like that's what they're supposed to do because that's offering the best service by saying, shop around. Like, what do you say to that?
I mean, I love that you asked this question because it's the thing that makes me want to scream. Why would I, in good conscience, want to create more work for a consumer? Because I'm basically pitting a stage of rate shopping, which is not in the consumer's best interest. If that's the case, as an agent, I ask you, then why are you handing out 3 physical people's names? You should be handing out 3 online lenders because they have lower rates because their margins are compressed. So if it is about shopping rates and getting them the cheapest stuff, what are you handing out 3 names for? You're handing out 3 names because you're supposed to do it or they tell you in your market. But you and I both know that you have a preference towards one. There's a preference that you have maybe because of a built-in relationship or they're on brand with you or they make you look good. Some of you don't even hand out 3. You actually just give the one. I know that when I go direct to consumer, which is always my preferred route, I go direct to consumer. When I say it's time to pair you up with an agent, I'm giving them one name that I've thought out that I know is going to be a home run for them. It's going to be a great match. Personalities are going to line up. And yeah, you can't control everything. So I'm 99.9% sure. But I don't want to create more work because if I hand you off, Craig, and say, I want you to call Joe at Compass, Joe is phenomenal. He knows this market inside and out, that particular neighborhood. He actually lives in it, the one that you want to live in. He's going to be an ally for you, and he's helped countless friends of mine. You're in great hands with him. Craig, you're like, thank you, man. Like you made it easy for me. Not, hey, Craig, here's 3 agents. One's at Compass, one's at this one, one's at this one. I give you a Bible on all of them, and I think I'm doing a great service to you by explaining all this. And you're reading this like, shit, man, I got to do all this work. Like now I got to interview these people. Like you made the job harder for them. So I've never been able to understand that. I think if you're a lender listening to this, what you have to do is train your referral partners, right? You've got to get in there and sit down with them and teach them what is the best way to refer to you. I tell people, listen, don't even, if you're telling your clients that it's about getting the lowest rate, don't even include me in the 3. Honestly, I might have the lowest rate, I may not. But you're kind of setting this whole thing up for a space that I don't really want to be in. You're almost cheapening what it is that I have to offer. I have so much more to offer than that. Now, if you start talking to your agents like this, you'll raise your posture. They'll look at you a lot more differently because every other lender out there right now is begging them. They've got 50 emails in their inbox offering to take them to overpriced coffee or pick up the bill for some lunch. And the realtor knows they're not going to give you anything. They'll just take you up on the free meal because they need it because they haven't closed the deal in a while. You're going to waste a lot of time that way. But you can turn the tables on people by bringing this kind of value and having this to offer as opposed to just being someone that's out there begging for the business.
Love it. I absolutely love it. So, Arjun, you have quite a resume as far as martial arts, a 2-time Taekwondo world champion. I mean, that's Look, as someone who took Taekwondo classes in my younger years, I mean, to think of a world champion, that's pretty impressive. And then, of course, the former Team USA co-head coach. So let me ask you, have you found that your martial arts background has had any sort of influence on your mortgage profession?
100%. The two hats, most in particular being co-head coach for Team USA, because being a coach and being a mortgage advisor, they're completely synergistic. They ebb and flow together because it's all about taking somebody from point A to point B, from aspiring athlete to world champion, from someone who was really scared to ultimately becoming very confident, from renter to owner, from saver to investor. I'm about taking somebody from here to there with a game plan, with a process, standing side by side with them, never letting them feel like they're alone, and pouring into them because it matters to me, right? Like any of the athletes I coach, they have my name on their back in terms of the pedigree and the work. So it's got to matter, right? I care about what it says out there, what I'm putting out into that space or that world. The same thing on the mortgage side when someone moves in. So I have felt that it's been a really nice marriage between the two, to be honest with you. Like, it's been easy. And not everyone can say that about their passion, side hustles, or the things that they do. Sometimes it's not a match, but I've been fortunate in that space where it was. Also, in terms of the student of Taekwondo, which even after 36 years, I'm still a student, right? Like, I still go, I have to keep up with my own pedigree and my own craft. That's a great reminder as well for like everything that I'm doing, you know, as a mortgage guy. I've got to get better. I've got to get sharper at this knowledge base. I need to understand markets better. The work is never done. So there's a great martial artist, a world famous one, Bruce Lee, who has this quote, which I love because it applies both to business and into athletics, martial arts, or mindset, which is that human beings are all merely works of progress who mistakenly think that they are done from time to time. You're never done. The work is never done. You got to keep going. You got to keep getting better, keep getting sharper, keep digging in, staying hungry to improve. And if I do that as a mortgage professional, I'm going to be, better than my competition. I'll always bring the right value by the consumer and the partners I work with. If I do that as an athlete, I'm going to set a good standard and example for the people I coach, the peers I'm around, for my daughters, because I want them to see that in their father. And, like I said, the two just very fortunately merged together very nicely.
Yeah, no, that makes sense. I love it, man. I love it. So lots of opinions about mortgage rates. So I have to ask, I ask everyone, whether or not you're a real estate professional or a mortgage industry professional, what are your thoughts? What's on the horizon for mortgage rates in the opinion of Arjun Dhingra?
So it's twofold, right? We all know that the single biggest driver or influence of rates is inflation. And as inflation continues to cool off, we will see mortgage rates come down. That's just the way they've always gone historically. That's why they got up to the points that they did. Inflation was kind of dismissed. It's not, it's temporary, it's transitory. And then all of a sudden it was like, oh crap, it's really here. And once it really set in, you saw mortgage rates spike quickly. That's what happened. That's the quick history lesson over the last 18 months. They stayed up for a while. There's been moments when inflation has shown real signs of reversing course, and it is. The data is showing that month over month, it's coming down, it's trending better. So we will inevitably see lower rates. That's why this is such a great buying opportunity, and why I say if you can negotiate a better deal with higher rates now, great, because you're not going to keep that rate very long. Your chance of being able to restructure this debt somewhere in the next 8 to 10 to 12 months is going to be there. The other factor that hasn't let them come down as quickly as maybe they should have is a lot of the other economic stability. We had debt ceiling negotiations that were going on. There's been some geopolitical strife. There's things that are kind of unsettled here on the home front in terms of what's going to happen tax-wise. So when you have some of that uncertainty, it's not really good for the mortgage bond market. But eventually that stuff will start to normalize, right? You had the banking crisis with some of the regional banks closing. That had a very negative influence. So as that noise starts to quiet, the other side of inflation we already know is trending lower. We had a great print last week, and it's going to continue to come down and down over the rest of the year, the rest of these months. So this will cool off. This will quiet down. We will see lower rates. Are we going to see historically low rates ever again? I don't think so. Being a gambling guy, like coming from Nevada, I wouldn't put my money on it that we're going to ever see like rates with like a 2 or a 3 handle on it. I think 5s are very, very much likely where it's heading. And then, there's always buy down opportunities to get into the 4s or adjustables. Those are phenomenally low rates, especially when compared to where we're at now. So the opportunity will be there. I think people, if you're watching rates, that's what you need to watch for. Is the rest of the economy kind of starting to cool, inflation continuing to come down? If you're not so concerned about it, then you don't need to worry about it. But I can just tell you, you can rest assured, they will be there at some point in the future. It's just a little bit of a waiting game. It will cool off, and either by way of, again, inflation coming down, or there being a recession, because in recessions, the government has to step in at some point to re-stimulate the economy. So they do the opposite of what they've done over these last 18 months, which is start to cut key interest rates. And that ultimately will influence mortgage rates and bring them down a bit and then get money going again. So remember that the Fed is nothing more than just the person whose hand is on the lever of controlling the money supply in this country. When things run hot, they tighten that faucet, and they tighten it by raising interest rates, trying to suck money out of the system and slow things off, try and cool off the economy. When the economy then kind of, you start to hear the brakes and you start to hear that loud noise of that it's maybe coming to a little bit of a too quick of a halt, they'll open up the faucet, get money into the system by cutting key interest rates, stimulating growth. So that's all they do. It's just a game. It's levers that they pull, right? For the last 18 months, we've been where they've been tightening. But at some point, they don't want to tighten too much. They're going to kind of try and loosen it or maybe stop tightening and then reverse course. So you just kind of wait for that. But they go up, they go down. It's a normal cycle. It's part of the U.S. economy. It's never going to change. But it's nothing to be fixated on or worried about.
Good stuff, man. So let's talk
Sorry for the economics lesson there, Craig.
No, that's what I wanted to get from you, man. No, that was perfect. So as we start to wrap up today's show, tell me what's up next for you, Arjun. Tell me about My LFG Energy Society.
So this is a group, a community that I've wanted to create for a while of mortgage professionals, real estate professionals, entrepreneurs, marketers, to just all go to focus on personal growth by having access to speakers and people that they wouldn't ordinarily have access to, people that operate on a high level, ex-Olympians, world champions, entrepreneurs, successful startup owners, world-class marketers, or people that are big names within our industry, and coaches, in the real estate or mortgage or marketing space. So I wanted to create that. I've done this twofold. The launch officially will be the online community that'll come on later this year. But up until this point, I've done a quarterly event for people here in the Bay Area, which people travel to. I just host them here. But a quarterly event with somebody big or somebody influential. And that's, the whole essence of what LFG Energy is. It stands for exactly.
Can you let out any secrets as far as like any of the big names or anything like that?
No, of course. So last year we had a massive event with Ryan Serhant. We brought him out to San Francisco. He gave an amazing keynote for 220 agents. It was a private invite-only event. We had a lot of fun with it. He and I did a very cool house tour in San Francisco and got to shoot some cool content together. I did something earlier this year in Q1. It was called the Social Boss Lady, where this was, again, a real estate focused or forward event for the agent and lender community. We had about 200 plus agents and lenders here in the Bay Area that came. And I brought on 4 rock star female panelists that were in the social media coaching game, the branding game, a realtor, and a lender, to give all kinds of perspective. And it was a fireside chat, panel discussion with Q&A. It was phenomenal. But this all gives value. So I'm very much in, subscribing to the mission that if we all become better marketers, the industry will thrive. It'll survive all the disruption from fintech and technology in general and what's going on with people trying to shorten the process or whatever. So if everyone becomes better marketers, getting better at that craft like I talked about, and then marketing it better, you'll be able to outlast. You'll always have a place in this market. So the events I put on are always to help aid that mission. And we've got a big one coming up in Q4 this year in November here in San Francisco. We haven't announced it yet, but just watch the airwaves for it. It's going to be a really exciting one day, the single biggest day of real estate content and masterminding ever to hit San Francisco that we're going to do. But again, people from around the country are welcome to come to it, and they will. But yeah, doing events like that and then launching this online community, which I'm really excited about, so that nobody ever feels kind of stranded or out there, for inspiration, for hope, for ideas, for community. Because I don't know about you, Craig, but 08, 09, those were dark years, right? And for those of us that were in the industry, there was no community. We couldn't even tell people what it is we did because we were public enemy number one. I I distinctly remember being on airplanes, and I'm always a chatty guy on airplanes. I always talk to people because I picked up so many clients that way, and also amazing friendships. People, and I would talk to them, and then when they'd get to, oh, what it is you do, I couldn't even tell them during that time when I'd be flying somewhere, because it was that, it was that negative. It was that kind of like an avoidable issue. And that was tough. But I remember there was no community. You couldn't even like collaborate with other lenders or other marketers or real estate people. Like everyone was just trying to figure out how they were going to survive, whether they were going to quit, stick it out, whatever. It was just really weird, dark times. That feeling I had, I never want anyone, if I have some control over it, whether they're on my team or they're, part of my circle, I never want them to ever feel like that. So I want to create this community that makes people feel supported, uplifted within this space so that they can continue to have an impact, because what we do is important. And you gotta feed the human that's providing that important service. So that's what this will be about.
Well, and great insight. And, on that note, like as far as, whether or not people want to kind of check out what you're doing here later on this year or whenever, what's a good way for people to connect with you, Arjun?
Definitely over Instagram, I'd say first and foremost. Find me on Instagram. You can also find me on the Mortgage Reports podcast, but I think Instagram is definitely the best way. It's just at Arjun Mortgage is my handle. I love interfacing with people that way. So if you're a real estate professional, if you're a lender, a consumer, and you ever want to talk anything, just shoot me a message on there, and that's how we can connect.
Nice. So as far as a few key takeaways here, Arjun, so higher rates, actually a good thing.
Yep.
Financial literacy, necessary, especially for our upcoming generations. And what about, is there anything that you'd say to folks, because of course there's a lot of them that are fearful and uncertain about the current housing market. Is there any advice that you have for those folks?
Well, I think you just want to look at whatever the cataclysmic ending is that either the media is portraying, which you got to remember there's an agenda there, right? And this isn't a political statement. This is just, it's business. Bad news sells, right? Bad news gets clicks. Bad news fuels advertisers. So everything you see is generally going to have a very negative spin on it, or it's going to present doom and gloom. It's easy to fall prey to that, but I think just take a step back and take it also with an ounce, or with a grain of salt, and then reapply some perspective. But I always like to say, when I listen to something that someone is trying to either make me worried about, weary of, scared, discourage me from, I think, okay, well, wait a minute. Why are they doing that? Number one, and I just answered that for you. And number two, what would it actually take for this thing to happen? This thing that they're painting. And for housing, and those that are paying attention to housing, housing crash is one of the biggest searched phrases on Google right now from consumers. And that's no secret why. I mean, it's quite obvious, right? They read about it, they're hearing about it, there's higher rates, there's doom and gloom, there's an imminent recession, or we're already in one, depending on, how you view or how you define that. So if you try and map out what this cataclysmic thing is that could happen, what would it take for housing to crash? Because right now we have, and it comes down to supply and demand. And this is the takeaway I'll give you for those of you that are watching it. If you want to know, is there going to be a crash or not? You have still way too many people chasing too few homes. The only way a market crashes is if that flips. Okay? Not just levels, but flips. Levels would just mean that we probably have even more harmony in the market. Equal number of buyers, maybe a little bit less in terms of inventory. But right now it's a wide gap, which is why prices can't come down, which is why there's no crash. But for a crash to happen, we would suddenly have to have a bunch of homes hit the market and a bunch of buyers exit. So what would it take for that? Massive job losses, a huge economic crash, companies closing, basically a widespread, deep recession, similar to what we had in 2008, would need to happen in order for there to be that kind of job loss and that kind of inventory suddenly hitting the market. So then again, take it further. Is that even likely? Is that going to happen? Nobody has a crystal ball. None of us know. There's always these black swan events. Nobody could have predicted COVID. Nobody really saw how bad 2008 could be. People were predicting that maybe the market was too hot, but nobody thought it would have this kind of widespread global devastation. So is that likely to happen? And the answer is no, it's not. Barring some sort of serious collapse, again, a black swan event that nobody can see, nothing out there is showing us that there's going to be a massive job loss recession or that we're going to have catastrophic labor issues, which is going to force people to sell because they can't afford their homes. And even if they did, let's just go ahead and play devil's advocate. Even if they did, What are they walking away with now that they wouldn't walk away with 15 years ago? Equity. Right. Because homeowners are sitting on records amounts of equity. And what did I say earlier? Housing never goes out of style. They need shelter. So they'd sell their home and go to another home, or they would rent. So it would recycle itself. So when I play that out, all the doom and gloom out there, and hopefully this helped you as an exercise, as a listener to this, it doesn't really add up. Does it mean that it's impossible? No. Anything is possible, right? But you have to think about things practically, pragmatically, and use some logic and reason and data, like I just presented with you, even though it's not necessarily formal data. And then it kind of puts you a little bit more at ease. So if that helps you out in kind of quelling some fears as a consumer and as a listener of this podcast, then I did my job there, because those are the facts. I'm not saying you got to go out and buy. I'm not saying you need to call me or call Craig or call anyone. None of that is a sales pitch. Those are just facts, and play it out. So do those two things whenever you hear something and you're trying to figure out, could it happen or not? Is find out, why are they telling me this? And what would it actually take for it to happen? And when you've done that exercise, you'll find out that maybe it's not so bad.
I knew you were going to be a great guest to interview, Arjun. So really good stuff.
You know why you knew that, Craig? You know why? It's not for anything that we've talked about thus far, brother. It's because you knew, or you learned today, that I'm an Atlanta Braves fan, and you live in Georgia, and you're an Atlanta Braves fan, and that's why we're buddies.
Hey, that definitely helped. I'm not going to lie.
It helps big time, man. So, we're friends for life now.
Special thanks to the Mortgage Reports for making this episode possible. I want to thank all of our listeners. And wherever you watch or listen to your podcast, if you found today's episode to be helpful, please rate and review it. That helps us grow and reach more listeners. And if you know someone who could benefit from today's episode, please share it with them. Arjun, our listeners, I think you said the best way to contact you is on Instagram. So, I really appreciate you taking the time to spend with me today. And I know your time is valuable. I know we've tried to get you on here a few times. You're a busy man. So thanks for taking the time to join the show, because we've learned a lot, and I really appreciate your time today.
I appreciate you too, Craig. It's my pleasure. I'm a big fan of this platform. It's connected me to amazing industry professionals like yourself. I think it provides a very, very solid resource of information, and it's really someone that's in the consumer's corner. So thank you for all you're doing, brother. I'm grateful that we connected, and also glad for our friendship now.
Absolutely. And we'll definitely be having you on again. And I wish you the best of luck, Arjun.
I look forward to it. Thank you, brother.
All right. You got it, my man. Thank you.